the man behind the first hedge fund in France and managing over $700 million in capital.
You have to understand the trend and you have to understand where you are in the market cycle. And then the technical will give you the timing, trading map, the risk reward. You can have a very good idea, but if you don't buy your ideas at the correct time, probably your ideas can lose money.
Sylvain Lemaire is one of the biggest names in the French trading space, never having a losing year as a hedge fund manager.
The best marketing in finance is a performance. If you are good, people want to invest in your fund.
What do you think hedge funds are doing these days? Because I'm seeing a lot of BlackRock and other firms getting involved with Bitcoin.
I think all those hedge funds are very, I think you have to put in place some sets of risk limits. After 8% drawdown, I start to decrease all my position because it means that there is something changed in the market and I didn't understand. If you have to understand why you didn't perform and how and when, you need to come back more stronger in the market. You need confidence to make money.
When it comes to this topic of risk, which I wanted to come back to once I understood your technicals and fundamentals view, how did you navigate managing that pressure to have hundreds of millions of dollars under you? What does that feel like when you're placing a big trade and you know it's a large amount of money? What are those moments like?
This is a very good point. That makes the difference on a good trader and a bad trader.
Ladies and gents, welcome back to another episode. I'm joined by Sly, or Sylvain, as we can say in French. We have a very cool career that I want to share with the audience, where you've worked in real prop firm, you've been a hedge fund manager with hundreds of millions of dollars with your responsibility, and then pivoting to now ventures that you're doing. A very interesting career. So first of all, thank you for joining. I want to start off with just a summary on the things you've done, because you've had a nice and interesting career, starting from your university and masters, and just some bullet points to present date.
Yes, globally, I think at the end of the 90s, if you wanted to penetrate a big dealing room, big banks, for example, because in 2000, hedge funds was not so common. The trading was more inside the banks, big banks. So in France, you have SocGen, BNP, Crédit Agricole. And if you wanted to go for this bank, to work for those banks, you need to have a good diploma. So the way to have it, you have the three best business schools. So we spoke about it. It's HEC, ESSEC, and ESCP, and the top engineer schools also. And that's it globally. So you need to have those kind of diploma to have the chance to become a trader.
Very competitive.
Yeah.
Yes.
And then you start as an internship, and then I do my military duties.
Oh, you have that in France as well?
Yeah,
Back then, okay.
Yeah. I did it at the BNP. So I did my internship in BNP, my military duties in BNP also, and then I started as a junior expat at BNP. And I started asset management on equity side at BNP. This is the way I was able to go in this industry, in these activities.
And from BNP, which was a prop firm, I guess, where did you transition after that?
After that, I went to Dexia. Alphi Gestion Dexia was the first hedge fund in France.
Wow. Okay.
Yes, those guys were totally amazing, the best traders I ever seen. And I launched here the first long-short equity market neutral in Paris. We met a very great success. We raised around more than 500 million in 2 years.
Wow.
Very huge performances, because those guys understood the way the market is, the way the market perform every day. So we had on my left the desk on the fixed income. Me, I did long-short equities. On the right, there was the options guy. So all the information on all asset classes were there. So we had an advantage on the market because we know everything at any time on the market. And this is the way we do trading. And this is the way I do trading again today. So I learned so much on this place. I stayed maybe 2 or 3 years at Alphi Gestion and then Dexia. It was so amazing, totally.
There's a lot to unpack here. I think I want to start almost at the beginning. So your degree, and it was international finance, you said?
Yeah.
Your master's. a lot of people that I've had on the show are, they've had their trading performance, and they've done their thing, but very few, I think maybe not any, have had a formal background on the show. So just for the people watching that maybe are choosing the path and thinking, okay, if I want to take this professional route or hedge fund route, how essential was this degree? And is the things you learned there still useful now in your trading?
I think you learn the basis of the economy. Because at the end of the day, trading, if you want to do trading, you have to understand macroeconomy, the world where you live. This is what is very exciting for me in the trading. So you have to understand the world where you live on a daily basis. And if you have a very good education, a good degree, you learn the way you live, you learn the macroeconomy, the microeconomy, you learn trading, you learn everything. So this is only the basis. And then you can start and make your proof in this industry. And at the end of the day, the only way you say I'm good or not good is the P&L you are able to generate. And if you want to be able to generate P&L on a constant basis, continuously, you need to have a process, a method. You need to manage your emotions, your stress, because I think your main enemy in trading is you. If you are rigorous, a disciplined guy, I think you can do trading for 5, 10, 20 days because you manage your stress thanks to your methodology and your process.
I'm interested to know your classmates at university who all went to, as you mentioned, one of the best universities in France, and doing a tough degree at a master level. Did they all go on to be good traders, or were these things like emotions and psychology?
Yes.
Even at a degree level, master's level, can still hold people back?
No, I think there's a lot of very high-level guy, like high IQ guy, they do very well, but they stop because too much pressure or too stressful. This is real. At the end, if you are not able to manage the stress of your position, the stress of your P&L, because nobody can make money on a daily basis. You have always up and down position. So if you are not able to manage that on the long run, at the end you just stop because you're not happy. It's very bad for you.
When you entered as you said, the first hedge fund in France, when they launched, after how long did you join?
No, I joined this company to launch the hedge fund.
So you were there from the beginning.
Yeah.
Okay,
yeah.
in that case,
because the company was existing for 5-6 years, I don't know, but they recruited me to launch this hedge fund with a senior guy.
Okay, I see. In which case then, since you were the first movers into this space, what were the challenges you faced? Was it a lot of capital coming your way because it's new, exciting, but also a lot of stress, regulatory pressures? I'm sure there was a lot of chaos going on to launch this. What was that experience like?
I was very impressed by the quality and the skills of those guys.
Okay.
So I wanted to be as good as they were. So I think I worked 24 hours for 1 year every day. Yeah.
And the things you learned in university, you mentioned as well off camera, they taught you some technical analysis.
Yeah.
Is the things you learned at university at a master's level relevant, or is it more what you learned from your colleagues in this hedge fund?
What I learned during my degrees were really relevant. It allows me to start and to know what I want to do, and to know the way you can trade, you can take position, you can manage your risk and stuff like that. And then this is the theory, and then in the reality, it's very different to say, okay, I have a very good chart, it's a good, strong buying signal. It's different to think that, to say that, to advise that, and to take the position and to leave the position and to manage it. This is two separate worlds. And I think the good traders are able to do this both sides, because you have to create a process, a methodology that will work in the most market condition as possible.
A lot of traders end up frustrated bouncing from website to website, trying to figure out which prop firm is best for them. And that's why I'm proud to bring to you a partner of the show, Prop Firm Match, which is a complete, trusted and comprehensive comparison website. And with all kind of filters on their website, you can select the prop firm based on exactly what you are looking for and see their credibility based on verified reviews of actual customers, and also get insights on how long that prop firm's been around, if they are denying payouts or not. And overall, in one place, you have third-party verified information so you can make a sound decision on where you should put your money. Because Prop Firm Match is the largest comparison website in the industry, they're able to negotiate the best prices and the best discount codes with all of their prop firms. But also with their loyalty program, you are able to collect points from your purchases to go towards even more credit and more discounts in your future prop firm purchases. So go ahead and click the link in the description to research the best prop firm for you and find the best prop firm discounts in the industry. When you take your theory that was from university, which is just maybe how to get started, it's geopolitics fundamentals, versus a working strategy, taking theory into application, as you were saying. What was that building process like to take your theory into actual execution ideas?
But I had the chance to start trading activities with very good traders, very good traders. So I wanted to take a position for any reasons. I can discuss my business case or my investment case with senior guys, and I learned like that because the guys say, okay, I think it's a good point here. This one is not a good point because that and that and that and that. And I started to say, when you do trading, you have to understand the world where you live. When you do trading on equities, you have to understand what is going on the interest rate, on the fixed income, on commodities, on the forex, because it impacts a lot of equities. If you want to go long on UK name, which make 50 or 60% of its revenue in the US, you need to have a view on the euro of the cable, on the euro pound, for example, on the US dollar pound, for example. If you don't have this view, at the end of the day, you can trade only the currency to trade the equities. Because if the pound collapse, so all the UK exporters have an advantage in terms of competitiveness, in terms of price. So you have to always to see everything when you do trading.
So when it comes to the strategy that you had, it was not, the final weight is not only on your shoulders. You have a team around you, and you can bounce ideas. Now I can see this working in a great way because you have support, and you have not only the emotional support, but then you can get some feedback. But it can also maybe give conflicting views where in the team someone has this idea, that idea, because it's not an exact science to understand the economy or the health of an economy. And down to an individual level, let's say me, I can trade by myself or I can trade with my friends. And my friends might all get me excited to enter a trade that isn't usually my plan, or vice versa. This is my plan, but they might convince me otherwise. How did you navigate individual opinions versus team mentality?
This is a very good point. That makes the difference on the good trader and the bad trader. You have to have your own conviction. Okay. Your conviction could be feeded by this guy, but at the end, this position is my position. So I am responsible of this position. That's it. If you think, okay, my position is very good, my investment case is perfect, the market is wrong, it's not the way it works. The market is always right. Always right. Always. So when you take a position, it's your position, it's your responsibility.
In a hedge fund environment, I imagine you had a risk team or a risk desk. Yeah. Does externalizing that responsibility, so you're not going to ever revenge trade, FOMO trade, over leverage, these things are out of your hands. Does this alleviate a lot of pressure, or is this something that is just, you have to do it?
You have to do P&L, okay? So you have sets of limits, risk limits, in terms of leverage, of beta, of everything, of volatility, and you have to navigate inside those sets of limits. And if you are above, if you are a breach of those limits, you have the compliance, the risk department, they come and say, okay, what's happened? And you have to cut and stuff like that. So
okay.
It's more like the police guys of the...
It's the rules, basically. Yeah. You have to follow certain rules. Yeah. Okay. At your peak, you mentioned 700 million was being managed.
Yeah.
before we even get to that point, how did you get to raise that much? That's a huge number.
The best marketing in finance, in trading, is a performance.
Yeah.
If you are good, the people want to invest in your fund. And then you have a good marketing guys and good sales guys. They have to understand your process, understand the quality of the portfolio manager, and have the network to sell the fund. But
how long were you managing funds for in this
yeah,
time?
it could take too much time for a portfolio manager to raise fund. This is a bit. It could be painful because the job of a portfolio manager is to make money.
Yes, exactly. So you don't want to be mixing roles. Okay.
You will do more money for the portfolio manager if you manage a lot of money. So if you make 10% on 1 million, it's not the same commission than 10% on 100 millions.
Exactly. Yes. What kind of performance did you guys see in this time?
Me, I never had a negative year.
Oh yeah.
Yeah, my worst year was 0.74%.
Just about break even.
Yeah.
Okay.
And my best year was 17%.
And from which years were you doing this?
Between 2000 and 2008.
Okay, so and the crash, I guess, the 08 crash was a time for you to exit, or what happened there?
For me, when there is a crash, when a crash happened, for me it's more an opportunity to make money. Because there is a lot of spread, there is a chaos in the market, so you can take advantage of it. But you need to react very quickly, because if you are not in the good way, if you are long and there is a crash, you have to know your risk and act very immediately, very urgently to cover your position, to hedge everything. So you need to know your risk at in a real time. And as I said, I think the job of a senior trader is to know at any time what is priced by the market. Like that, you can react very quickly when the news happen.
This now in 2025, are you managing people's money or your own capital? What is your life?
I
look
advise
like
a lot of hedge fund, bank, traders, and high net worth.
And individual trading or not yourself?
No, because I am regulated by the DFSA and FSA, so I cannot do both.
I see. Okay, conflict of interest, I
Yeah.
guess. Okay, so I'm interested to just hear, like, when you're giving advisory now in the current climate compared to when you were trading back in the early 2000s, has things changed? The markets, the way to view things, the way to trade?
I don't think so globally, because it's for me the market is something very cyclical. What we are seeing now, we saw this kind of behavior in the past. The way it could change, and the way it changed actually, is the rapidity of the market adjustment. Because sometimes there is too much money and the market converge too quickly or more quickly. And today, no, I think it's always the same situation. We have a US president wants to cut the interest rate. Powell, the Fed, doesn't want, because the imported inflation is too high due to the tariffs. But I think the main goal of the US government is to decrease the value of the US dollar, to decrease the impact of the inflation first, and to make more competitive the US companies all around the world. And when you see the threat from China, because they own 30% of the treasuries of the total debts of the US government.
China does?
Yeah.
Okay.
And everybody said, okay, but if they sell everything, interest rate, the long-term interest rate in the US, the 10 years, will go up very sharply. But I don't think so, because for me, the plan, because I think those guys are definitely not stupid. They have a plan, for sure. And the plan for me is to take what the Chinese own on terms of treasuries, to take back inside the US, to make them more independent from outside. So there is two ways to do it. And Berkshire, Warren Buffett, announced already that they bought a lot of treasuries. Okay. And probably the Fed could do also. He could force the Fed to buy in sort of new quantitative easing, just to buy the treasuries from the Chinese guys. Like that, you have a pressure on the US dollar, but not on the interest rate. I think this is the plan.
I want to take a moment from the episode to remind you of Alpha Capital, a long-term sponsor of the show, a leading prop firm in the entire industry. And in the last year, they did over $50 million in payouts. That's why they are a top-ranked prop firm that's been around for years and is not going anywhere. And with the multiple step plans they have and the multiple packages that they have, there is going to be something catered specifically to your needs at the most competitive pricing. And because we have a long-term relationship with them, we are able to bring you a massive discount of 20% off all evaluations. So click the link in the description or use the code TOT to get 20% off all your funded accounts. Working with the best prop firm in the industry, Alpha Capital.
So the goal is to strategically bring down the value of the dollar for competitiveness.
Yeah.
But the strategy that he's going about it can also invite counter tariffs, as the situation right now with China is. Is this just noise, you think, and it will eventually settle and is just kind of headlines and politics, or is this a real threat, you think?
No, for me, to renegotiate some contracts older than 50 years is not abnormal. Mm-hmm. This is the way he does it. This is a bit conflictual and nervous for the market. It brings a lot of volatility and noises on the market. But if he does it another way, probably he will obtain less than he will obtain doing that this way. The rude way.
Okay, in terms of a leverage here. Yeah. Okay.
Because nobody has interest to fight
the US.
To fight US, but to fight all together, because that you destruct a lot of value.
Okay.
Globally, the US economy is below zero today. So he wants to force the chairman of the Fed, Jerome Powell, to cut the interest rate. This is the main goal. I think he is creating the condition for a huge bullish market.
Do you think the play of the interest rates or him trying to strategically pull it down is more associated to the US debt, which is at all-time highs, or is it more to create an environment of spending and a booming economy?
Exactly. He wants to create an environment to favor the investment and the spendings. And the main point for me, he will succeed if the treasuries, if the 10 years rate won't go up. Because if the interest rate, the 10 years go up, the real estate market will go down and then the consumption will go down sharply.
Okay, so yes, there's a balancing act between him trying to bring interest rates down, but also the effect of inflation right now. And what is the view on that side, on the inflation itself? It's high.
There is another point, very important. In 6 months, 5 or 6 months, the Senate has to vote for the tax reforms in the US. I think there is something like, I don't remember the figures, but billions of dollars at tax-free for corporate and a lot of others departments. And like that, you will create a really strong economic environment inside the US.
I guess the goal is also to bring, with the tariffs, the goal is to bring production and manufacturing into the US to not only try and export, but also not rely on external factors.
Yes, but I'm not sure. I'm not so sure of that, because yes, he want to, because at the end he's right to say, okay, China's prices are too low and commercial balance is too deteriorated for the US. But in China, I don't know, but I don't know, they are doing a T-shirt at 0.20 cents when you produce it at $1 in the US. So there is something not fair. But at the end, the US guys can buy a T-shirt at 20 cents. So this balance is not so conceptually. It's not so easy to address it. But if you bring back all the industry on the workers in the US, you will create inflation.
Yes, because whether it's tariff or whether it's US made, it's going to be more expensive either way, and that has an inflationary bubble. And yes,
and inflationary by the salary is the history, the economic history
yes,
showed that it's not a good idea. But
from the commentaries that I'm seeing online, it seems that we're creating an environment where, yes, it's going to cause a boom in the economy. That's what projections may be. But it's also going to create a huge wealth divide, or increasing wealth divide, because the middle class or the lower class, they're just going to experience more expensive things, everything, cost of living, inflation. And it seems like for the wealthy, they're the ones that are going to benefit in the end, and they'll have tax breaks. Which brings me to this point. I don't know if you saw the day when he announced the 90-day pause of the tariffs, he made a tweet about it. And I was very curious, why is he tweeting this? And then I see a video a few hours later. He's in the White House with some of his buddies, Charles Schwab included. He's like, he made this 900 million, he made this, laughing about the whole situation. It brings me into this point of like, in your opinion, is he a president that is for the economy, for the people? Or do you think he's just part of the elites and his goal is to make wealth for himself and his buddies and then use the economy as a way to catalyze his own growth?
He's a businessman at the beginning, so...
Yeah.
He's still a businessman. No, for me, it's very clear. He's not. I don't think one president is here for America. Probably they are all here for themselves first.
I think especially when you have a 4-year window to make change, everybody thinks short term. You think, what can I achieve in 4 years? And you're going to make policies that are not, you don't care about the long-term inflation, because you'll be gone as a president.
But I think he has a lot of ego also, so he wants to be the president to make the America great again and stuff like blah, blah, blah. But if the interest rate short-term and long-term in the US are lower, it's going to be very good for everybody in the world. So I think he's creating conditions to make in place a very strong bull market.
Yes.
And specifically in 1 year, because in 1 year he will the Fed chairman will change. He will probably put in place someone close to him, and it's going to be easier for him to...
Does the president have any control or influence on who can be in the Fed?
Yeah, the president will elect the future chairman of the Fed.
I see.
But this guy has to be independent.
Yes, they don't have influence from the government, which is another topic, I guess. But now that we've kind of arrived to this summary that the environment is shaping to be positive for the US, so then people can start to see, okay, the stock market is on a 20% discount right now. Yeah. But then there's also the recovery path might not be so smooth, and we also don't know how to time it. So how do you take an environment where you think within the next year or year and a half, things will be better than they are today? How do you position yourself into a trade, either technicals or what do you connect?
For me, from a point of view, I published, it was in French, but I published in my YouTube channel a study on the S&P 500. And for me, we touched probably the bottom mid-April. And
you mean when they had the 90-day pause and then a bounce? You think that's the final low?
Yeah, because technically speaking, it's the case on the Dow Jones and the S&P and the Nasdaq 100. We touch the support of the bullish trend since 2020, since the bottom of the COVID.
Okay.
So it's a real important key level from this point of view. And then, for me, U.S. government tested the market, tested the investors, and they saw that it was totally not under control. They lost everything. So they step back. They say, okay, now everybody, we threatened everybody. So now just go and negotiate. And this is the way Trump did during this first mandate, exactly the same way. But it was only with Chinese guy. Now it's with everybody.
So this 90-day pause, the way I understood it is like it's a short-term pause. Let's get some relief. But then it's going to resume after 90 days and it might continue going lower. So is there an argument that this could just be a temporary bull trap or a temporary euphoria and then it continues lower?
I am an optimist guy, so I don't know what will happen after 90 days, but for sure, after 1 year, every single country would have negotiated with the US. So it's just a question of time.
I see.
Because the market expressed something. The market said and states the fact that US economy against the world, it doesn't work for the US. Because the underperformance of the S&P since the election of Donald Trump was more than 20% against the Euro Stoxx 50. So the market said, okay, US against the world, it doesn't work for the US. But probably now, if the European countries doesn't negotiate with the US, they know in advance that they will lose everything. Because Chinese will sell all their product in the Europe, so the European industry will collapse totally. So they need to negotiate. Everybody has to negotiate.
So after this, let's say Trump tested the market, the investors showed that US versus the world is not a positive route you should take. Do you think now Trump is coming into these negotiations with less power or less leverage? Because everybody saw the reaction.
I am not sure. Because for the moment, it looks that he will win, because Thailand, India, Vietnam, they all said, okay, 0% tax on US goods.
Okay.
In Europe, you have Italy and Spain. They want to negotiate. France and Germany country doesn't want to negotiate. Probably there will be a good deal for the UK and the US also. There is a very strange situation between Canada and the US. We see it's very, 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 very strange. I don't really understand, but probably they are very close. They know them each other very well. So I think they will find a way to work together. And then the real target is the Chinese. But Chinese, they want to negotiate, and US wants to negotiate. Look, at the end. And I think the first minister of Chinese is here not for ideology, he's here for his own health also. So they will find a way. It's like Putin and Trump. At the end, they all have the same interest.
Do you think it's true when people say that China doesn't need the US as much as the US needs China?
We don't really know. Nobody don't really know, because it's like the tariff. Okay, when you make a car in the US, first you will buy some caoutchouc from I don't know, Mexico, and then you will buy electronic system from China, and then you will buy something else in Canada, and then you bring everything in the US territory and you do something, you assemble the component, and then you go back to Europe, because in Europe, I don't know, there is something special, and then you go back again in the US. So you will put tariffs on each. So they don't know, actually, they don't know how they can do something intelligent and it works. So probably they spoke about qualified product, probably like iPhone. But because I don't think an American guy wants to buy an iPhone at $3,000.
Exactly.
Well, today they produce 20% of the iPhone in India, and tomorrow it's going to be 40%. But in the meantime, it's going to be a nightmare for Apple. So I think all those situations is really a lot of noises to have a better place to negotiate.
Do you think with a lot of uncertainty, no matter what the markets, including Forex, including commodities, that we are in a time of all-time high of uncertainty?
No, not at all. Because, you know, when if you measure the uncertainty by the volatility of the market, like the VIX index or V2X on the European side index, during the COVID, the VIX index was at 95% at the top. At the top during the tariff turmoils, it was at 50%.
Okay.
So it was not a position of crash or real uncertainty, because And if you have a look on the sector's performances, you see that the defensive sector in European market went up. So that means there is a lot of investors going to sell the cyclical part of the market and buy the defensive side. So they don't put their money in cash. So it's just a game, you're right?
I see. What do you think is driving, maybe even I could say Bitcoin is kind of flying at the moment, but more specifically gold, because gold didn't even have a dip. It's been rocketing as a safe haven. I was using that as an index to say, okay, the world is uncertain, so they're going towards gold. Is that a correct read, or do you think there's something more going on?
No, it's right. But what is very interesting, it's like, for me, it's a Bitcoin. Because, okay, there is a lot of uncertainty, so everybody wants to buy gold, right? I think it's a mistake, because if the war in Russia ended, the gold will drop sharply.
You think a big influence of gold prices right now is the uncertainty of that war?
It's a part of it.
Wow, okay.
And if the war ended, US and maybe the world economy will have access to commodities at a cheaper price.
Because of Russian production?
Because of Ukrainian production.
Okay, and that's significant?
Yeah, very significant on the wheat and the soft commodities.
I see.
So it's going to be easier to import from Ukrainian and also from Russia for the oil and gas, for example, specifically for the European countries. So the inflation will maybe decline a bit thanks to this situation.
I see.
So the geopolitical situation, for me, is really clear. The way they want to go is very clear.
It doesn't seem like the US is particularly trying to help influence the end of this war from the things that I see, which is limited. What is your view on that?
No, I think the most powerful guy in the world is Putin.
More so than Trump?
Yeah, probably, yeah.
Wow.
And but no, it's very no, because first of all we have to take back a few years ago. You had the end of the war in the Middle East when the Russia came into the game.
True.
And finished everything. And then few years after, you have the Ukrainian and the Russian fight it together, right? But I don't think Zelensky woke up a morning and said, okay, I want to join OTAN. Probably he was forced or pushed by the US. I think the US wanted to have more precision about Russia army.
I think it was also expanding NATO to the doorstep of Russia, yeah.
Definitely. And now I said, okay, we saw Russia is not so strong. And Russia now, in the army, you have a North Korean guy, you have a Chinese guy, they fight together. So he said, okay, Russia is not so strong. I think this is the first element. But Putin, for him, it's everything is okay, it's under control. So they have to find both a way comfortable to end the war. And the discussion will be between Trump and Putin.
So the current situation that we saw in the White House with Zelensky and Trump and that attitude, it very clearly showed me that it's not a partnership, it's not anything, it's a very like inferior, superior kind of dynamic, down to how they would even address each other. I think that's also a reflection of that war altogether. With the things we're talking about now of just elections and wars and all these kind of topics, it's implying to me you're more of a swing trader in the hedge fund days and also in this moment. When it comes to swing trading in general, do you believe that having a strong fundamental bias is the most important thing and technicals comes after?
For me, it's 50%.
Okay.
You have to understand the trend and you have to understand where you are in the market cycle. So it's more a macroeconomic view or an analysis. And then the technical will give you the timing, the trading map, the risk reward, and what you want to buy or sell. Because if you are bullish on the market, either you really bullish on the market, you just want to buy an index, or it's better to buy some stocks or some forex, some currency to play your view actually. And like that, and for this part, I use the technical.
When you mentioned timing the market, are we talking just about let's say a market structure demand area, or is it more what else could it relate to?
Probably you can have a very good idea, very good investment case, and you're right. But if you don't buy your ideas at the correct time, probably your ideas can lose money.
Mm-hmm.
So the market timing is everything in trading. So if you want to go short on the market during the COVID, at the beginning of the COVID, and you say, okay, I just wait 1 or 2 days, you just you miss 20% of the move.
Mm-hmm.
So the market timing is everything.
And in this case, let's say when you have a V kind of reaction, as you're saying now, the price is tapped in. It's already up 10% from where it was. I'm talking about the S&P 500.
Yeah.
Do you think then it's still sensible to wait for a retracement and then get in or
Yes.
dollar cost average, or do you think the best opportunity is always in that initial timing?
Yes, the best opportunities is on the key level.
Okay.
So, and if you want to find a key level, you have to make an analysis on the long-term charts. Because short-term charts doesn't work when you have too much volatility.
The long-term charts, you mean like the weekly and daily time frame?
Yeah.
Okay. And the flip side of me is thinking, how do you avoid catching a falling knife? Like it's just going down and down, and you don't want to. You arrive to a key level, but at times it can blow through the key level too. Do you wait for any sense of confirmation or rejection on those levels?
Good question. First of all the intermediate supports, you can just forget them. Okay.
Meaning 1 hour, 15 minutes?
No, meaning intermediate trend. You know, you have the main trend since 2020 is very clear.
Yes.
I can show you actually. I have my computer somewhere.
Sure. We can throw some things on the screen as well. Yes.
It's very clear. So when you touch this level, you know that if you are above this level, the bullish trend still remain in place. And if you are under this level, so probably you start a bearish trend on the medium term point of view. So you can buy straight this long-term support, this key level, with a tight stop loss, for example. It's the first way to do it. But when you have, since 2020, this kind of move, all right, your support is here. But here you can find an intermediate support.
Yes, in between.
Okay. Those support, when you have a lot of volatility, you can just ignore them because it doesn't work.
And on the flip side, or let's say the devil's advocate of this, is you have a very clear, obvious level that you can see, I can see, and the rest of the world can see. So if everybody is waiting for that level, maybe the market doesn't even arrive there, and you get a premature reaction, or something changes, like a Trump tweet.
Exactly.
In these cases, I know I'm talking about a very specific scenario which is happening right now, but in general, in the market, you might have an idea and it doesn't meet that idea. How do you then react accordingly if it's not come to your key level?
I think it's very, very, very good question. When you are on a key level, most of the time the market reverses without any news. Just the time for investor to come back in the market.
I see.
When you are above this level, you didn't touch it yet, but the market reverse. Most of the time it's because there is a news.
And is that important, or is that more noise? It's a
no. It could be.
reaction.
It could be important also. It could be important also because to feed a bearish market, you need to have every day bad news,
fear, and
bad news and bad news again, worst and worst and worst. After 20-30% losses, if the market has to continue to go down, you need to have more bad news, not priced yet.
Mm-hmm.
So it's not so complete. It's not so easy. It's like on 2008 and 2009. At the end, when the market said Goldman Sachs has only 2 days liquidity in their balance sheet, and after that it's bankrupt, like Lehman. Wow. Okay, this is the end.
Yes. Well, when it comes to involvement in managing large funds, because I'm completely uninformed. Are you managing the books in the sense of put put a dollar cost average in the S&P, put some in gold, put some in the bonds, and kind of hedge around in the markets? Or are you deploying large capital for specific trade ideas?
Normally, in hedge funds or trading in banks, even if trading in banks disappeared globally, you cannot do everything. You are focused on your process. So your process is long-short equities, is volatility, is options, it's futures, whatever. But it's very rare to be able to trade every asset classes.
Is that simply because you have a responsibility to your clients of
because you
larger returns than the market?
No, because you sell a process. And in your process, it's specifically written that you can, your universe of investment is this one.
And the regulator enforces that as well.
Of course.
I see.
Yeah, of course. You have what we call the shitty ratio. Globally, with 10% of your assets, you can do whatever you want. But not more. Yeah.
With that 10%, what do you think hedge funds are doing these days? Because I'm seeing a lot of BlackRock and other firms getting involved with Bitcoin.
Yeah, I think all those hedge funds are very, very, specific. Each trader has to invest on a very limited assets.
Okay.
But there are maybe 1,000 of them.
In general, just out of curiosity, what is your view from the professional background that you have and the professional education that you've had on the cryptocurrency markets?
To be honest, I don't really understand the cryptocurrency market.
Okay.
Me, I have in my bank account, I have US dollar, I have dirham, I have euros, I have Swiss franc, I have pounds. If I want to buy a Tesla, I just use my US dollar account. Why I have to use a Bitcoin? I don't really understand.
What about just aside from utility, just an investment vehicle? Because we can see it does outpace on a month to month. It's a lot of noise, but on an annualized basis, it beats the S&P.
Yeah, it depends. Yeah. I have to check.
You don't have a formal position on it or view on it necessarily. Fair enough. When it comes to this topic of risk, which we mentioned earlier on, I wanted to come back to it once I understood your technicals and fundamentals view. You kind of made a claim that it's one of the most important things that held people back, that you noticed in your peers, or a very significant portion. How did you navigate managing that pressure that you mentioned certain of your classmates couldn't, to have hundreds of millions of dollars that are responsible under you? What does that feel like when you're placing a big trade and you know this is a large amount of money? What are those moments like? Because
you have to think about relative performance and not in terms of absolute dollar.
So is that something you can do? Like, of course, thinking in percentages will help, but you know, in the back of your mind, okay, this percent means this in dollars. I guess it's hard to escape.
No, because when you work for an hedge fund, the goal, of course, is to raise the more funds as possible, so to manage the more funds as possible. But what wants your investors, they want to have a good returns. So you always have to think about returns, not about US dollar or absolute.
Okay.
And but when you manage a lot of money, you need to pay attention of the liquidity of the market. You have a lot of different things you have to look at. If you manage 1 million euro, it's very easy to buy and sell and buy and sell. And when you manage 700 million or 1 billion, it's very hard to buy and sell at a good time. You have slippage.
Okay.
So this is more important this way, because sometimes liquidity on the market is very low.
What amount of assets under management do you start to face these liquidity issues?
I was PM in hedge fund in 2026, 7, 5, 6, 7. Liquidity was lower, and above 500 million, it started to be difficult to trade my way, of course.
I see.
If you are a Brevan Award and you take a huge position on futures, it doesn't make any differences. But my way, I like to take a big position with a strong view and to trade this position not every day, but on specific levels.
In the 8 years that you were involved in the hedge fund, how often did your thesis or strategy or ways of trading change or evolve, let's say?
Yeah, I think the main change was after the financial crisis.
Okay.
With the policy with interest rate at zero, it was all the metrics we used, the value metrics we use disappeared totally, was totally inefficient. Let me explain you why. Because when you manage a big mutual fund with billions and billions under assets under management, and your mandate is to buy corporate bonds or just fixed income, with interest rate at zero, you make less money than the management fees. So all those guys has to find a proxy to the bonds. What they did, they just go to the equity market and they bought equities with specific axis like high dividend, quality of results, quality of management, sustainable growth over the time. This is why we paid L'Oréal, for example, the French company. L'Oréal is a very nice company with maybe 8% organic growth every year since 20 or 30 years, with I think 11% operating margin, and the price earning ratio was historically around 15 to 20. But let's say 2014 until 2019, or until the COVID actually, I think the PE was above 40. So it was totally crazy, makes no sense, right? And the only way to explain that is just to understand the structure of the market. Who make the price? Mm-hmm. And the mutual funds made the price at this time. And if you don't have this view, you cannot understand why you pay L'Oréal at this price.
What was your best year of performance?
It was in 2001, I achieved 17%. 2005, I achieved 15%, 40%, but with very low volatility of the performance.
And what was the difference between these years where was your best performance and the year you had a 0.75%?
Yeah, at 75%, I was eaten by...
Even though you didn't lose money? It was
no. It was... I think the first 3 months of the year was really good for me.
Okay.
And globally, the first 3 months of the year are always good for me because this is the moment where the big investors start to build their position for the year.
Okay.
So you can see the flow. You can see in the charts the trends moving, right? So you can take benefit of that very easily. And then you have corrections, and those corrections are sometimes very difficult to address. And after that, you have the summer. And in summer, if you are not in the good way, normally there is very less liquidity. So all the movement of the stocks market are wider. And mm-hmm. I was not in the good way. And I was in holidays in Namibia, I think I remember.
Okay.
And I was eaten by 2 or 3 profit warnings. It was on 2011, I think, something. No. 2004. Yeah, 2004 was my worst year. And I took the profit warning badly on Nokia and 3 or 4 big names like that. So when I came back from holidays, I was up before the holidays 4 or 5%, and when I came back, I was down 3%. But it was a very good lesson because when you are on holidays, just cut your position.
Oh, okay. Even though you had infrastructure and team and so forth.
Yeah, your position is your position.
I see.
You cannot ask to your junior guy to cut your position if you are not here. You could, but the best way is just cut it.
Okay. And what was your reaction like after that in terms of after vacation, you've taken a sizable loss on your portfolio. What was the route to recovery? What was your mentality like afterwards?
I took a lot of position, but with a smaller size. to recover step by step, step by step.
As a trader, it's very simple. You have to find an edge and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your backtesting tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need. The correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it. And probably you'll be using it for years to come.
What is your philosophy on this? Because I've also heard the flip side, where it's like if you're 50% down, it's 100% to return, meaning like, and if you reduce your risk, then it's going to take even longer. And then the mentality of being in drawdown or being in the negative for even longer because you reduce risk. There's that side, but there's also, okay, your emotions are sky high, so reducing risk is more sensible. How do you play with both sides?
Yes, but no, I think you have to put in place some sets of risk limits. And on your total portfolio, you cannot accept to lose more than 20%. It's not, for me, it's not possible. After 8% drawdown, globally, I start to decrease all my position.
Okay.
Because it means that there is something changed in the market and I didn't understand it. So I just need to decrease my risk.
You decrease your risk to try and solve what's going on, or wait for the market to go back to another cycle?
Both.
Okay.
Actually, both. You have to understand why you didn't perform. You don't perform, actually. And how and when you need to come back more stronger in the market. You need confidence to make money.
How much of an influence does the election cycle have on overall performance?
Election
cycle, like election year and then midterms and then pre-election and all of these things that change
it depends,
policies and narratives.
Because sometimes some presidents, some situations are very well known and nothing will change. The big changes we saw, it was the Brexit, probably. It was unexpected. The first election of Donald Trump was totally unexpected also. And it changed a lot. Brexit changed a lot of things.
How so?
The pound dropped so dramatically. Everybody goes short on the FTSE, on the UK market. But when the pound dropped so sharply, every smart investors bought UK name, exporter UK name, actually. And it works perfectly. You have to understand that with the pound at a very low level, the UK market, which is turned with the outside country, it's an exportatrice country, you have a lot of opportunities to make money.
A bit of a different question, but I thought it's a good opportunity to ask. So I was watching some video maybe like 2 weeks ago, and it was talking about how every member of parliament has to disclose their positions publicly. I think there's a bit of a delay between them taking the trade and maybe a few weeks or 1 month later it becomes public knowledge. But it's very fascinating to see how members of parliament in the US, specifically they were talking about Nancy Pelosi and how she has historically in her career beat even the best of hedge funds every single year for an extended period of time. I think pointing towards insider trading and these kind of things. Is this something interesting to you that we can see the positions of people in power and kind of piggyback their ideas? This video even said that there's an app that has kind of made an index or an ETF out of members of parliament's positions, and you can kind of follow along. And historically speaking, you will beat the market just by following members of Congress. Do you think there's anything interesting in there?
Yeah, totally. I think they know a lot of things that we don't know. For
sure. That's how the world works.
And secondly, I think you see only a small part of their portfolio because probably someone else take position for them.
Do you think they're heavily monitored to stop that, or it's kind of they turn a blind eye?
Totally possible. I don't know, but globally, if I was on a politician guys with a lot of information, I want to take benefit of them, I won't take position on my own name.
At the highest of levels, we're talking hedge funds that have tens of billions or even more in capital. How clean/dirty is that game where it's just you're naive to maybe think that it's going to be all just great traders. It might also just be a lot of inside information and who you know and how close you are to Trump and these
Yeah,
kind of
you
things.
know, I think they are good. First of all, most of them are very good trader.
Okay.
Secondly, they are big firms, so there are a lot of information, a lot of analysts inside the firms, a lot of IT guys able to code a lot of
Right.
different models, so they have a lot of information. So normally they have to beat the market on a yearly basis every year, because everything is made for them. So and on top of that, they are very good. And secondly, the inside information is not so easy. In my career, I had a lot of inside information, but maybe 1% of them works.
Oh, interesting.
Yeah.
Okay. So it's not just like a
So if
easy blueprint if you
no,
know the right
no,
person. I
definitely
see.
not. Except if you are the CEO of the company and you know that you're gonna sell your company. But
Yes.
if you just hear the rumors of the market, you have to interpret them.
Okay.
But of course, it's a bit touchy. But if someone told me, okay, I heard that this company will be taken over by this one, and I know the company, and I can have a look on it, and if I see an increase of the volume of transaction, if I see a lot of different indicators moving in the same way, okay,
You can
probably
justify
it's
it.
real. But I do the work thanks because I heard something. But I cannot challenge this information. I don't know if it's true or not.
We mentioned that in 2000 compared to now 2025, how you don't think too many things have changed. The market is cyclical and follows that same behavior. But at the same time, we can also see that the world has changed. AI, tech, quantum
Yeah.
computers, just the level of education of the industry. Where do you think the future of the industry is, and do you think it's going to have more dependence on AI and bots and these kind of things, or do you think how it has been will always stay how it is?
But you know, if everybody do the same things, there is no opportunity
Cancels.
to make money.
Mhm.
So AI, okay, we do data crunching for 20, 40, 50 years already. So it's the beginning of the AI. AI, you put the generative AI, you put all data as you have, you put in the algos, and you have some input. When we create models, we select what we want to put in the models. We select the
Parameters,
data.
okay.
This is the difference, but it's the same prospect, actually. It's the same process. And I think today, the biggest hedge funds like Citadel, Millennium, Exodus, all those guys, they have a lot of very performer trader, but this one do only the industrial sectors. This one do only fixed income. And I think the futures of the trading was exactly the beginning of the trading, is to have a view on every asset classes.
Okay.
It's a global macro view. I think this is the future of the trading.
As technology advances and you have involvement in bot algorithmic trading and developing them, do you think the future is going to be more algorithmic and therefore less emotions, or do you think there's always a space for manual discretionary trading?
Yeah, but you know, me, I don't like the systematic trading, because when you put a system in place, you have to follow it.
Is that not a good thing?
Yes, but you know that there is no trading system works every day. So when you have a big drawdown, you have to continue to do what the model says,
Yes.
right? And this is the way I don't like. It's not me, but you have to be comfortable with what you are doing on a daily basis. So for some IT guy or for some engineers, they like this kind of way to work. Me, I just use the algos and the system to have more information. But I like to say every morning, okay, I think the market will go up because of that.
Okay.
And if I'm wrong, because if you follow just models, if you start to build a drawdown and the drawdown start to become very big, it's very comfortable to say, oh, it's not me, it's a model.
Yes.
When you, on the discretionary trading, okay, it's only you. It's not the model.
There's no hiding. Yes. How much of an influence do you think intellect, IQ, has on the performance of a trader?
Yeah, of course, the biggest IQ you have, I think the best trader you could be. But I think you can learn trading, and you can learn the basis of the trading and make money with very simple things.
And how about
if you are a very, very disciplined guy?
Yes, that's actually going to be my question of, you might have a very intelligent person, but I would imagine the people that have more intelligence are also more over-analytical and overthinking, whereas the guy that is a normal guy, he might also have the courage to actually do things and not be in analysis paralysis. So there might be the element of system and planning over there. How about just the ability to regulate emotion? Excuse me, where you have people, even if you're working in a professional environment, you have a risk team, you have a system, but you have drama in your own life, personal problems, financial problems in your own life. Is that a skill that you can eventually just master?
Yeah. Your own environment is very important in trading. And also, you miss something, because if you have a very intelligent guy, successful guy, makes money every year, this guy probably has a very big ego also. And the
overconfidence.
And the overconfidence in the market is not a good friend at all.
What is your views on the new age of prop firms like an FTMO and so forth?
It's a good way to learn.
Learn, okay. Not earn?
No, learn. It's a good way to learn.
Why do you think it's a good way to learn compared to, let's say, deposit $1,000 into a normal brokerage account?
First of all, the prop firm, most of them allow you to take position without money, and then you are in a real condition of the market of a trader. So you are in the market, so you can analyze everything, every part of the trading, like the fees, the latency. When I think something, I send another. When it's executed, why, the slippage, everything. You have to learn all of those points, because if a bad execution in trading is deadly.
Yep.
So you have to manage everything. It's not difficult. It's really easy, but you have to be focused. You understand the fees, understand the turnover of your portfolio. If you make 1% by each trade because you do only scalping, but you pay too much fees, it doesn't work. So you have to understand all these parts. And prop firm for me is a good way to start. And when you are confident, go to Interactive Broker. I think these are the best, and you start really. But you have to understand all those small details to launch and to engage a lot of capital.
I finally have a special offer to share with all of you from the US, or my futures traders, which is over 20% of the listeners of the show. And that is Alpha Futures, a leading futures prop firm that is working with Trader8 and NinjaTrader that are compliant with CME regulations. With the largest end of day balance drawdown in the industry, a 90% profit split and same day payout. And with the most competitive pricing in the industry, with accounts starting at just $79. On top of that, just by being a viewer of the show, you get up to 40% off all evaluations. So why not get started with an evaluation right away, trading $50,000, $100,000, and you already know the power of prop firms and larger capital. So go ahead and use the link in the description or code TOT for the best prices in the industry, plus the best discounts in the industry, to make this a home run offer if you are a futures trader.
If you were a trader that didn't have the education and then you couldn't take the corporate route, let's say, how would you have become a trader? Let's say you start with prop firms, you make a few payouts, you got $10,000, $20,000 in payouts. Where do you go from there if you don't have an institutional route?
You have to train yourself. So you have to be coached by someone who is good. So a lot of people offers coaching. Me, I did. I do actually. You can buy very good education and start slowly. If you have internet connection, you can go to Yahoo Finance, and you start slowly like that. And you just train yourself. And if you go faster and more professionally, you take a coach.
How important was mentorships and guidance like this
Yeah.
in your own career? How important was that?
I think my experience at my first experience in a hedge fund was critical. Without that, I think I would not have been the trader I am today.
Meaning guidance, coaching, all these things are, me too, I'm a big advocate. Everything I've achieved in my life is either me searching on the internet or me asking and being coached by someone. I think learning from your own mistakes can also be, as you said earlier, deadly. You can fall on your face too many times and never get up.
It's very easy to lose everything in trading.
Yeah.
Trading is based on experience. So you have to make mistakes, to learn from them, and if you have a good coach with you, you will do your mistakes, but he will explain to you, and your mistakes won't cost you too much.
We spoke about earlier how you allow yourself to have a bit of flexibility in your system, not just completely mechanical, and you have your own, let's say, intuition involved. Intuition is something that I think can be powerful when you have the right experience. But at what point should you allow intuition to come into your decision making and not let it just be emotional noise?
Okay, for me, in this job, you have to take pleasure to do it. If you have intuition, just play it, just go.
Okay.
But as I explained to my students, if you want to survive in the market, you have to put in place a trading plan. And the trading plan is all the rules of your trading activity. It's like the size of your position, your stop loss, your take profit, how you will manage your position when it's open, everything. Okay. You think because you are just happy, it is a sunny day and everything is okay, I want to buy the market. Okay, why not? Just buy the market. But you put your stop loss and you respect it.
Yeah.
That's
Okay.
it. At the end, you have 50% chance that the market go up or down. So why not?
Yeah.
I would say it's not a question. Of course, the trading is a very intellectual activity. And when I see a lot of video on internet, online, say, okay, I do copy trading and stuff like that. Okay, I said, okay, don't believe that. It's shit. Okay, the trading you need to have an intellectual reasonment. Okay, you have to think what you do. You have to understand what you are doing. You have to masterize everything. That is trading. So if you copy someone, you are not responsible of what you are doing. And in trading, you have to be responsible of everything, because your position is your position, it's not the position of someone else. Mm-hmm. At the end, if you make money or if you lose money, it's due to you, not to this guy or whatever. So this is the main point. But you have to follow your intuition, you follow your logical, you follow your work, your analysis, and just go. Mm. But you have to control your risk. This is the main point. Don't never see the P&L you can achieve or reach. Just see the max losses you allow to have on each single position you're gonna take. This is, I think, the main rules in the main advice I can give is this one.
That was actually going to be my final question. In your, I guess, 25 years in the markets and many cycles and all the experiences that you have, what would be the lasting advice you want to give to a trader who is on year one?
After 20 years in the financial market, I didn't improve my French accent. First of all. Secondly, be responsible of what you are doing. And just understand that you have to put in place a trading plan. The trading plan will force you to be disciplined. And that allow you to manage your stress on a daily basis, because just follow it. When you put in place your trading plan, is based on objective criteria, because you don't have any position at this time. When you have your position and things goes wrong, badly. You can be very too much emotional. You can wait. You can whatever. You can have the worst behavior as possible for a trader. If you follow your trading plan, you will survive.
Sylvain, very, very honored to have you on the show. I think your credentials speak for themselves, and in the end, a wonderful episode also. Thank you for joining us.
Thank you very much.
Brilliant. There we go.
Thank you.